Today, we'll be looking at a notable change in the daily breadth numbers, as well as a short-term momentum divergence that's currently in place, and look at an update on the current patterns for the S&P 500. So let's start with a very traditional view of breadth. This is just the S&P 500 cumulative advanced decline line. And from the lows here has been a straight shot higher, just like the S&P 500 itself. And because of the way this is constructed, made a new all-time high a few weeks ago as the market continued having that second push higher after that pause in November. And so, as we know, S&P has yet to make a new all-time high, getting very close to doing so, but so far it's lagging to that extent. So if you look at it from this perspective, breadth has been a leading indicator so far. And a different way of looking at it is just by taking a look at the percentage of components trading above their respective moving averages, long-term 200-day intermediate term trend, 50-day, and of course short-term 20. Now, we talked about this along the way, first noting how soon after the market bottomed here, we hit over 90% of the stocks above the 20-day, and looked back at certain times in the past showing that just because it hit it the first time didn't mean the market was about to roll over. And so that really worked out again because this really held in there for the next 2 months or so. And so recently, after hitting 90%, looking at the 50-day, or percentage of stocks above the 50-day, and very close to 80% for the 200, we've seen this now come off a bit. And again, no surprises considering that we've had such a big run. Eventually, both seeing the S&P 500 and its components stall as the moving averages catch up, this type of thing is going to occur. Now, not surprising to see this come down as much as it has. You can easily pull back to, say the teens, just the way it, versus a short-term moving average. But the big question is, how much more do we expect these measurements to curl over, right? Because we've seen even in 2023, when they peaked, that's when corrective action happened both times. Now, a different way of looking at it is this. And so what we have highlighted here are the last 11 trading days and the times when the S&P either had fewer than 30% of the stocks advance or more than 70. As we can tell here, there's been a distinct advantage to the down days where we had 4 of the times when the S&P had 30% or less of its components higher versus just one time, right? On January 8th, when we had that big up day. And so a very short time span, however, is notable compared to what we've had in the past. Now, here's some context, right? These are those 4 days with less than 30% advancing stocks over 11 days. If you go back to the beginning of the rally from October 30th here, there are 4 days as well over 42 trading days. So just about 10% of the time versus roughly 40% of the time now. Again, 10 days versus 40, not apples to apples, but this is how things change, could potentially, right? You want to see clusters of different type of activity happen after a big run. This is one of them to pay attention to. So conversely, looking at this times we had more than 70% stocks advancing, right? Only one time going back to, this is 26th, so over 13 days, so less than 10% of the time, versus 16 occurrences all the way up to that point. So over 40% of the time. So really, you think about those ratios have flipped, right? Where all this, of course, was dominated by some good up days and very strong breadth, right? Talking about 70 to 100%, and this time was not, right? So it's something to pay attention to, because if the trend continues, even though the biggest names have been holding the market up as it has been, right? If the foundation has been weakening a bit. So the notion is that if the Mag 7 and the like have to catch down just by math, the S&P, NDX, and other areas like that obviously will have a bigger negative effect. And so as that's been happening on a short-term basis, this is a 2-hour chart we talked about before with a 14-period RSI. The RSI has been moving lower, or at least having lower highs along the way, topping out right in the middle of December here as the S&P continued higher. Now has been in this trading range over the last few weeks. Now, we've seen this before, even just a few weeks ago, from the middle or the late November to the beginning of December, very similar thing where it finally came off the highs as the RSI was moving lower, S&P was in this tight trading range, and really all that did was create some digestive activity that the S&P finally took advantage of and then moved higher from there. So could the same thing be happening now where this is just setting the stage for another up leg? Of course, that would be the best case scenario, right? Having sideways movement after a big run and hopefully setting the stage for additional bullish patterns to take advantage of. The difference, of course, is that we're higher than we were now, right? And things, as you pointed out before, rolling over just a bit. And also is that it still hasn't taken advantage of this area yet. So the more, it fails, maybe buyers will start to get impatient, right? And start to unload some positions. Now, because of that, we've also looked at this from this angle where even though we're coming back down to potentially oversold, it hasn't been there just yet. And so the point being there was we look back at this period when it paid attention or made sense to stay in this trade for as long as this short-term RSI was above oversold territory. And really that let us take advantage of this breakout all the way to here. But as soon as that happened, that really did a very good job of marking the top of this move. And so we had a close call a few weeks ago. We noted that at the time, market was able to rebound. And so still above that now. So I still believe this is a good strategy to have, right? In terms of putting in a stop loss, so to speak, where as long as we're still above this oversold point, still stay in this. Just keep in mind that if a big down day does occur relatively soon, even with the RSI now, your 40, it could very easily then get pushed down to the 30s and potentially, cause a bigger drawdown. And so with that, we're still waiting for the first bullish pattern to be completed in 2024. It's come close a number of times. You've shown different versions of this. As it develops now, this looks like the most appropriate view to take, where this is a potential higher low here. And if we do get a bounce relatively quickly, you can see how this could complete a bullish cup and handle pattern, but not yet, right? You're still waiting for this to occur. And of course, all that is still occurring on top of this breakout zone, right? Still, I want to say comfortably above it, but you can still see this cushion here, right? And so anything really that holds above 4,600 would keep this intact and, of course, then maintain this 5,030 upside target. So we continue to have our eye on this in particular, because even if this, we form a topping pattern here, double top, downside target would still be right around here initially. So these are all short-term phenomenons right now. This is the most important level to hold as we go forward. That's it for today. Don't forget to check out these videos and subscribe. I'll talk to you next time. Thank you.